You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to the London South East podcast. This is the Investing Matters podcast with Peter Higgins. Today I'm speaking with Simon Young, a fund manager at AXA Investment Management Group, and he manages the AXA Fund Blue Chip Equity Income Fund. Hello, Simon. How are you today?
Hi, Peter. It did change its name a little while back to the very easy UK Equity Income Fund. So the blue chip bit has gone, but it's now the Equity Income Fund.
Thank you for that correction. I mean, for me, Simon, I wanted to start because you've had a very eventful life in the investment industry, which starts back in 1997. And you were fortunate enough to be starting at Mercury Asset Management, which is now part of Blackrock. And you were part of the grad scheme in 1997. And fortunately or unfortunately, you've informed me that you walked straight into the Asian crisis. So I suppose we should start really with, what did you learn most whilst in the graduate role? And how do you support graduates now?
Thanks, Peter. Yes, it was, like a lot of people, I wasn't entirely sure what fund management was. I had a good idea, but you then go into a graduate role, and the first thing they do is fill your head with investment theory. So things that your readers may have heard of: weighted average cost of capital, Miller and Modigliani, optimal debt burdens. But reality is that the most important thing is, as a graduate, I believe, is to keep your eyes and your ears open, keep your mind open, because ultimately you're going to adopt or work out your own best way of working, but it's going to take a bit of time. So don't go in the sort of preconceived idea that you know how to be the world's best investor, because it's all about learning over time and picking up good advice from experienced colleagues. And that was something that I really tried to take on board. And as you say, the first thing you don't get prepared for is an economic crisis, whether it's in the Asian part of the world, when we saw some serious devaluations of currencies over there in places like Thailand and Malaysia, or subsequently, only about 3 years later, we had the dot-com boom and then the dot-com bust. So you're learning the whole time, which is the best bit of it. So that's what I would say as a graduate, is to just take all those little bits of information, the little wins, the little losses that you'll have along your career, and start formulating a way that for you to get the best out of your own ability. I mean, some people are great traders. Other people are sort of much more long-term investors. And it's about what suits your temperament, what suits your abilities, and then try and work to that. And in graduates now, I mean, unfortunately, we don't have any formal graduate program at AXA on the fund management side, but I've done that role, done a bit of mentoring in the past, and it's really rewarding. And I think we may come on to some things that have shaped my career. So, because I think you asked me beforehand, it's a really rewarding part.
Excellent. So you said about, as a graduate, learning as much as you can from many other people. And you actually were given the opportunity quite early on, really, to start managing client money as early as 1999. You started looking after clients' money. So what was the learning from that, in the sense of you have this responsibility, you're a custodian of other people's money, you're trying to enhance that for them. How was that for you as a young person starting out?
Very scary, is the honest truth. What are we there for? We're trying to help clients, whether it's individuals or institutions, to meet their financial objectives, ideally sooner than they would otherwise hope. So there's a lot of responsibility on you as a fund manager to do that, and you do take it. I find I do take it personally when things aren't quite going to plan. So it was within a structure at Mercury. People were allowed to flourish and given, albeit small pots of client money, but to that client, that's the most important pot of money. It's their own. It might not be the biggest, but it's the most important to them. So you've got to be pretty humble about that and take things carefully. But I was lucky because I was working in a structure. We had oversight from much more experienced fund managers that you would sit next to and talk to. And often the reality is, while you're coming up with a couple of your own ideas that you're researching, also you're leveraging the team in which you're working in. So you've got specialists in areas who will be recommending a company, and you'd be mad not to take their advice.
Indeed. I mean, I wanted to ask you probably a bit later on, but I'll ask you it now in the sense that you've worked with some absolutely exceptional individuals. Do you want to share some of the stories and the highlights about some of the individuals you worked with and who they were and how much impact they had on you as a young person in the industry and also as a senior now, the people that actually have enhanced your learning?
Yeah, and I think learning is I've said it already, but you never stop learning in this job, or in any job. The natural state of things is to atrophy and ultimately die, whether we're talking about the universe or plant life. So what we're going to do is try and keep growing to delay the onset of that atrophy. So I've learned from some fantastic fund managers over my time. There's a lot that I've done, and I won't sort of embarrass all of them by mentioning them, but Aviva is a fantastic role model to young fund managers when we were at Merrill Lynch Investment Managers, which acquired Mercury, I should say. He was so generous with his time and explaining concepts. His huge encyclopedic knowledge of all these small caps was brilliant. And he's just such a generous person with that and very humble. So that was something. And then you got people like Pete Davis at Lansdowne Partners. Pete was just so far ahead of people of his age. You could see it in just his sort of left field thinking. So you piece together all these very brilliant individuals and you try and sort of shape your own learnings.
Indeed. I mean, I want you to touch on, if I may, obviously during that time when you're getting all this support and you're learning from all these absolutely established individuals, you're all at the same time going through various different the financial impact going onto the markets and all the crises, dot-com crisis you've already mentioned, and 2008, great financial crash and other bits and pieces that have happened in the past. How do you all then come together and learn and cope with the stresses and the strains of all of that in the sense of the capitulations of markets? And what was your learning from that?
I think that's something that I've probably done too late in my career, but it's something I look at now, is to understand where you've made mistakes and understand where things have gone right, but more importantly, where you've made suboptimal decisions, especially in hindsight. It's very easy in hindsight. I try and keep an investment, not a diary, but an investment thesis for each company that I hold, because I believe that you can keeps you true to your investment idea in the first place. And sometimes mission creep in a company can really sort of cause them to underperform. And if it's against what your original thesis was, maybe you should use that to sell the company. So I think keeping a diary is a good idea, or an investment thesis, as I should say, on each company is a good idea. And then just occasionally, once a year, twice a year, going back through your big investment decisions that you've made. Often it'll be a trade that you've made, and you can download those as an individual from Hargreaves Lansdown or Interactive Investor. You can get a list of your trades if you're an individual. It's obviously easier if you're an institutional fund manager, because you can pull the data out of a database, but the data's there for Hargreaves. And just think, well, what was I doing there? Did I make the right decision there? And if I did, what can I learn from that? And if I didn't, even more, what are my learnings? And some of my worst decisions ever have been in companies where they were more concept than reality. And by that, I mean, they probably had some revenues and were growing fast. And I was told they have a huge market opportunity, but reality that didn't come in. So I think one thing I've always said to myself now is I don't invest in unprofitable businesses, early stage ones. It's just not in my DNA. That's not my skill set. Other people are great at that, but it's just not for me. So my rule is don't invest in unprofitable businesses.
Yeah, I think that's a very good point you've made there. I wanted to ask you for a moment, if I may, to go back a second and just expand for those listening into this podcast on mission creep and what that means for you, but what it should mean for other people looking at the companies that they've identified initially.
Well, okay, I'll give you an example, and I'm I'm glad to say I wasn't holding this company, but I worked at a firm, as I've only worked at 3 firms. You probably work out it's one of them, that we had a holding in, my colleagues had a holding in Carphone Warehouse, and the big investment thesis, I remember this to the day, was that there was a huge market opportunity for them to roll out store in store, i.e. you have a little Carphone Warehouse store within the Best Buy stores across the USA. And it was going incredibly well. People hadn't really ever been sold, as I can remember it, mobile phones with a sort of great deal of yeah, on a basis that you could sort of choose your supplier. I think normally you went into like the AT&T shop or the Verizon shop, but anyway, this would give you a multi-supplier. And in the end, Best Buy, I think, seem to remember, bought out that part. It was a JV between Carphone Warehouse and Best Buy, and they bought it out. And it wasn't really mission creep, but it was more, the thesis had changed. I mean, we were in Carphone Warehouse for the fact that there was a huge opportunity for them to roll out these store in the US. And I remember distinctly sort of raising this point, and I was told that was fine. But anyway, I just remember it's one that really sticks in my mind. One, again, might be something like, companies where they start to believe their own success on M&A, and they go and do an M&A transaction, a merger or an acquisition in an unrelated space. What experience has that company got in that? And so that automatically raises a red flag, even though management will be telling you, yes, this is definitely part of what we've always been doing. We're really great at acquisitions, but ultimately, if it's in an area where they've got little experience, you've got to question it. Some of them may work out well, others may not, and you'll kick yourself if it doesn't work out as well as they told you at the time.
Indeed, you make a really good point there, Simon. I think the importance of being able to see the nuances sometimes and identify something independently that others may not actually notice. And I think that sometimes gives you and other people an edge, because people like to conform and look for other things that everyone else is looking at, but looking for the slightest nuance sometimes gives you an advantage.
Yes.
Okay, so having been both a fund manager and a private investor, what aspects of investing matters most to you, Simon, and why?
Well, as I said at the beginning, ultimately, why are you investing? You're trying to meet a financial liability or grow your wealth. And so as a private individual, and to tell people, I sort of ran my own business for a couple of years, and I had to do all my own investing with my family at that time, which was great. I really enjoyed it. And that's how I met you, Peter, and others. But also, and then I went back to full-time fund management, because the business I was doing was some consultancy, but my real love is investing. And so I got the opportunity to go back to AXA to be a full-time fund manager again, in which I leapt at. So ultimately, again, that is about trying to help people beat their financial goals. But through and through, coming into my career, it's about long-term investing for me. It's about the power of compounding of returns. And it's a pretty simple thing. Einstein described it as the eighth wonder of the world. And the numbers are quite stark, actually. And I sort of just jotted down some numbers the other day, which I happen to have in front of me because I was talking about this exact subject to someone else. And, if you do over 5 years, you do 10% per annum, that you make 60% due to compounding. Over 10 years, that 60 turns into 160. So you've more than doubled your money. And over 15 years, so the next 5 years, you then double it again. So you go from 160% return to 320% return. And then over the next 5 years, from years 15 to 20, if you're still doing 10% per annum, you go from 300% to nearly 600%. So it's about the long-term power of compounding. And so some of the best companies I've seen, people say, oh, they've done quite well, I might take a bit off the top. And there's a really interesting study by a US professor called Bessenbinder, who shows that the highest returns in the stock market are actually generated by, or the majority of the returns in the market are actually generated by a very small amount of companies. I think it's like 0.5% of all companies generate something like 80% of all the wealth. And therefore, if you can find one of these little companies that ultimately grows into a big company, and you look at the size of Microsoft and Amazon these days, they are huge companies with several $1 trillion market caps. If you can find these companies that execute on a plan, keep on growing, they are sort of gold dust. So, I think you, Peter, have invested for a long time. And I think I saw a tweet saying in AstraZeneca. So, maybe you could tell people about your sort of returns there.
Well, this isn't the right podcast to do that. This one's about you, Simon. But AstraZeneca has compounded from 1994. And the beauty of that company for me is that we're in the space of aging, longevity, and the need for ever more pharmaceutical companies to be prosperous and to look after our aging population. So that's why I'm still invested in that company. I think going forward, the use of AI, artificial intelligence, machine learning, is where pharma is going to go. So that's a company that's at the cutting edge of that as well. So investors should consider pharma companies that are involved in that space. Simon, I want to go now into, you at some point this month, if not you've already surpassed it, you're 3 years in now back at AXA Investment Managers. Yeah. Have you celebrated your 3rd year anniversary yet?
Yes, it's the 3rd. I've been there now 3 years. I took the fund over the beginning of November. So
Okie dokie. So I want you to start talking now about that fund. What is your theme regarding it? Obviously, it says it in the title, it's income, etc. But what is your thesis for that, in the sense of your selection of stocks, what's in the stocks, and what are you looking for regarding when you're looking to say, okay, I think that one has reached a point now where it's been fully realized, the potential, I'm going to look for something else.
Yes, I mean, as you say, I took over the AXA Fund Manager UK Equity Income Fund in November 2018, and guess what? Walked into another crisis pretty soon. I guess the learning that I've had is about resilient businesses, because whether it's, as I said, it's the GFC, it's the Asian crisis, it's the dot-com boom bust. I mean, ultimately, we're looking at compound at a good rates of return. And ultimately, I want businesses that can grow kind of whatever the weather in many respects. I want them to be able to survive the tough times and thrive in the good times. And so that resilience is something I look for. And whether that's, and there's 4 business models that I really look for in the fund, because I think these help with that resilience. Companies where they've invested in high levels of intellectual property. We talked about pharma companies, and we own a couple of pharma companies within that, and companies where they've sort of developed their brands. Again, that's intellectual property. The second one would be companies where they have high levels of repeat income. Companies where, a subscription service, for example, where the cost of that subscription isn't terribly high, but the utility of it is very high. And, accounting software would be a very good example there. You can't have a business without some kind of accounting software. Thirdly, would be businesses with high levels of very strong sales forces, so they can sell their products around the world. And finally, it's low cost providers, and we're seeing that at the moment. Businesses that have a structurally lower cost than many competitors can keep on growing their business even in the tough times, because people in the tough times, they'll look for value. So we're seeing it at the moment, out there. People are looking to lower their costs because they're suddenly going to get their energy bills through the post. I think it's going to be a big move to sort of low cost in the next couple of years because of some of the cost inflation that's coming through. And I think there's a number of winners, whether it's discounters in Europe, companies in the UK that are structurally lower cost.
You touched on IP, recurring revenues, and strong sales force and low cost providers. You want to give us some examples of the companies that fit that remit and currently within your portfolio?
Yeah, sure. I mean, a company that a lot of people know about is Games Workshop. They've been developing their intellectual property for 40 plus years, and obviously none of like other companies I mentioned are a recommendation, but I'm trying to use that as an example of companies where I believe it fits into the mold of what we're looking for. And so something like Games Workshop has very little direct competition, has huge amounts of they produce miniature figurines for the uninitiated, which they sell via their own shops and over the internet. But it's not so much about making these plastic figurines, which are incredibly detailed, but it's also about the backstories that go with them, and then the gameplay, because people use them in tabletop gaming. So it's a lovely concept. People actually talking face to face and playing a game rather than sort of doing it over the internet, as many of these computer games do these days. But coming on to computer games, they realize that their intellectual property can move into the computer game space. So they've done a lot of licensing deals, and they receive royalty income from computer game manufacturers, which in the last few years has averaged between 10 and 20 million. So it's a very profitable and high margin source of earnings for that business. So that would be sort of intellectual property. If you wanted an example of something in the high levels of repeat income, companies like Sage, the accounting software, they are moving their business into the cloud. So people will be able to access their accounts anywhere and everywhere on mobile phones or desktop computers. Again, people are paying upfront now. So it's a software as a service type model. You pay, I don't know, depending on the size of the company, between 30 and a few £100 a month, maybe more for some of their biggest products. But it's very difficult for a business to know what they're doing without accounting software. If you do it on the back of a fag packet or an Excel spreadsheet, it becomes quite dangerous, because ultimately you don't know how much you owe the tax man, you don't know how much you owe your employees, which is incredibly important, and you don't know how much your customers owe you. So there's a real benefit from having all this information to hand, and in a sort of low cost or relatively low cost product. Because if you think about the benefit relative to the cost, the benefit is huge, the cost is not so high.
Absolutely.
Investing Matters in association with London South East, one of the UK's leading share information websites for the private investor community, providing share prices, news and data straight to your desktop, tablet and phone.
I wanted to ask you, Simon, because you touched on the resilience of businesses there, and I want to just flip that a little bit and talk about the resilience of fund managers and the psychology and the mindset, and ask you what aspects of mindset and psychology has enabled you to deal with all the different aspects of what's happened to you since 1997. You mentioned, you've gone to that company and that company, and then straight away it's almost like a financial issues going on regarding the market. So you've had to deal with quite a lot. You're still a successful fund manager despite all the knocks that you've had. So talk to me about my mindset and psychology, and how that has worked for you.
Well, I think you have to develop a bit of a thick skin. Ultimately, we're trying to do our very best for investors, but times are going to be tough, and you've got to recognize that, and recognize the long-term goals are the most important. And I think sometimes it's very easy as either private individual or even as an institutional fund manager to be knocked off course by the short term, whether it's family issues, or whether it's economic issues, the macro environment. There's a whole, as you said, there's a whole lot of these inputs into you. And I think it's sometimes, as I come back to it, you'll look back at your investment thesis, because often when times are tough in stock markets and you're looking at a share price and you're thinking, well, the market must know a lot more than I do, because I think that the value is, let's say, 100 and the shares are trading at 50 or even 30. Don't forget that stock markets are made up of people who are also feeling these pressures and will be potentially swayed by the short-term inputs that they're feeling, the stresses and the strains. And so that's why I think looking back at your original thesis and saying, okay, I think this company is still worth 100, because I don't think anything's really changed. I think people are very nervous at the moment, but I think ultimately this business will keep on growing. So that one, you should sort of hold on to that position.
Indeed. I mean, this is the beauty of looking into the intrinsic value of some of the parts regarding businesses, I think. And I'm not sure enough private investors do that. I know you as fund managers are always looking for picking up bargains, but I don't think investors do enough of that. Maybe because the workload involved in actually doing that analysis is quite in depth at times.
Yeah, it's not always easy. And I think I seem to remember that one of the best ever fund managers, Peter Lynch, was always very keen on his sum of the parts and what the private market was going to be prepared to pay relative to the public market. And we're seeing that at the moment. We're seeing that the private market is prepared to pay substantially in excess of what a number of these quoted businesses are going for. And I think there's two parts to that. One, I think that debt is very cheap, as we know. The interest rate costs are incredibly low, and you can finance on high multiples in the debt market. So it's allowing some of these private equity businesses to buy out quoted businesses far in excess of what the stock market is valuing them at. And so I think that's a big issue at the moment, and we've seen huge amounts of corporate activity in the last 18 months.
Indeed, we have. And unfortunately, Simon, I think you and I are going to be seeing a few more stocks, shares and companies being taken over by private equity and other entities that are going to plunder the markets, because we haven't put a value on them ourselves.
I mean, I had one, I'm not going to mention the name of the company, but we got a takeover approach. It was before the financial crisis, the recent pandemic, I should say. I thought it was a slightly derisory bid, and I voted against the transaction, but unfortunately investors didn't. And I keep on seeing this company advertising on the radio at the moment, and clearly doing very, very well. And it sticks in my gut, actually.
Yeah, unfortunately, we're going to get some of those, which are, how do I call them, undertakers. Yeah, undertaken. Unfortunately, it happens occasionally. I wanted to talk a little bit, Simon, if I may, about your portfolio and some of the stocks that you've got in there, and your best investments that you've had since you took over the AXA fund, and just talk about how and when you identified those and thought, you know what, this is the right time for me. What were you looking at? What were the investing matters aspects of that particular stock that you identified and honed in on?
The most obvious one is one of our biggest holdings has been Games Workshop, which is just about trebled since we took it over, or since I took over the fund. And I actually went up, organised a visit with a couple of colleagues to go up and see them very shortly after I joined AXA. And that's because I knew the business from before as a private investor. I'd taken an active interest in it because it had a lot of the characteristics that always appeal to me. It's got incredibly high barriers to entry, incredibly high financial returns, and produced a lot of cash, so it pays great dividends. So, tick, tick, tick. And going up to see them is, something that is, and I was grateful to the company for allowing us just to go up and see them and see Kevin and Rachel, the CEO and the CFO respectively, and meet some of the divisional management. And I think sometimes that's the sort of advantage that we institutional fund managers have, is the ability to go and see these companies, whereas it's kind of more difficult often for private individuals to go and see the operations of the company. I think sometimes if it's a smaller company, and I know that I think you've gone and done some visits, and I know some of the other people in the Twitter universe organise small private investor visits at smaller companies, and I think that's great. That's really good. You're showing an interest in the company in which you're invested. That's fantastic.
Yeah, I mean, I've had the great pleasure of working and doing some stuff with your colleague, or former colleague, should I say, Alex Slick, regarding the IR stuff and seeing some companies. So that's been really, really useful as well. That's good for us that want to do that other additional bit of legwork to investigate some of these companies.
And the thing is, you don't learn, certainly don't learn inside information, that'd be totally illegal. But what you learn is you get a much fuller picture of the people that run the business. It's really important to me. I think the more I invest, it's about the motivations of the management teams. Buffett said, invest in a business a very simple business, because ultimately simple people will be running it, or something like that. But ultimately, I sort of turn it around. I think you can get a great business. If you get a great business aligned with some really great management, you've got a very potent cocktail there. So I also look for those management teams that are looking to invest for the long term in their business, and especially if they've got financial alignment, because they own a substantial proportion of their own wealth in the company, or their family owns a big holding, then that's something I would definitely look for.
Yeah, I mean, I think a great example that you've got in portfolio, you might want to expand on this a little bit. You touched on a low-cost business. Admiral has been exceptional for its shareholders, and also since they IPO'd, and they keep churning out returns and dividends to their shareholders. That's been a phenomenal success for the founder and the CEO.
Yeah, I mean, that has been an unbelievable sort of success story, as you say. I was looking up for an annual report I was writing the other day. It's returned 30 times to investors since it floated in, I think it was 2003. 30 times, of which 20 times has come from reinvesting your dividends. So the share price has gone up 10 times, but actually the compound has been reinvesting your dividend. And if you think about what was attractive about that business, it was entering into quite a sleepy segment. So it was going into motor insurance. Motor insurance always used to be sold via third parties, selling, agents or brokers. And they went in with a direct model, selling via the telephone. And then they soon realized, hold on, we can also sell via this thing called the internet, and it's really low cost, and not many other people are doing it. And then if we start our own website called confused.com, we can really learn about how we best optimize our product to sell more of it on other third-party price comparison sites. And then you build onto it. And I guess this is where the danger in my original comment about writing an investment thesis. Had I written an investment thesis about Admiral at the very beginning, I would have said it was a low-cost business that potentially had really excellent returns in the UK, but I would not have said it would have gone into France, into Spain, into Italy, into the US, into Germany. Germany didn't work, actually. They lost £20 million from memory or something like that. They shut it down. The US has been very difficult for them, but they've tried it. But they've also gone into, so they start out as motor insurance. They now have household insurance. They now have travel insurance. They're trying a bit on loans because they got so much data about individuals because of the questions that they ask on price comparison websites and also on from just the data they built up over time and credit histories, for example. So now they're going into loans. So had I written my investment thesis at the beginning, I wouldn't have had any of those ideas in. So I might have said, and like I didn't, actually there we should have sold the business, but they're in related areas, so which is why I think it still holds true. You know, they haven't gone into become a low-cost airline. Do you know?
Yes, indeed. Yeah, complete divergence. Yes.
No, they haven't decided to suddenly sell cars. They've always sold sort of financial products, so that's good too. And for me as an income fund manager, you know, as I said, it's compounded, I think 16, 18%, something like that over 25 years. But even in the last 3 years, it's up over 100%. So it's not all front end weighted, that return. It's some of it is still much more recent. And so they've been a real COVID winner. They have recognized that they needed to be agile. So they were one of the first companies to cut their prices to existing policyholders when COVID hit, because they realized that people were staying at home more. So they gave you a £25 back rebate per policy, which cost them over £100 million in profits. But actually, it meant that they got on the front foot and then they could start win customers. And they've taken on over, I'm going to get this number wrong, but something like over 200,000 or 300,000 customers in the last year alone, new customers. You know, it's a fantastic achievement. So it's gone from a business that had no customers to, I think the number is something like 5.5 million in the UK and 7 million or 6 million if you include Europe and the US. So, you know, fantastic.
Absolutely fantastic business and great leadership shown by the CEO and the team there as well. It's very, very important, I think.
I've just, yeah, funny enough, I just bought Henry's book. Henry Engelhardt was one of the co-founders along with David Stevens, and he's done a self-published book on Amazon. So you know, actually, I think that's going to be. I haven't started it yet. I'm still reading something else at the moment, but I think it's going to be a fascinating read because he's a really fascinating individual. So that'll be.
I'll definitely put that on my reading list and add to the library that my wife tells me I need to stop buying books, so I might get in trouble. I've got a couple more questions for you. What, in your opinion, are the aspects of investing that should matter most to private investors? You've touched on leadership, you've touched on recurring revenue, IP, and low cost, but what in your opinion should matter most to investors
in terms of investing and
investing matters? Yeah.
Well, I think you've got to work out what's the most important to you, what you're best at. I think that's what I would say. As I said, some people are really great at saying this share price, it can't get much worse. It can't get much worse. They're very good at the psychology of it, and they're more apt to be a trader. And then they'll say, actually, you know what? I don't think things can get much better here. And I've worked with a colleague who was phenomenal at that. He was just phenomenal at saying this, actually, everyone's got this now, so I'm going to sell it. And I was thinking, well, I can't see why you want to sell it. He sold it and he moved on to the next thing. And that's his psyche. So again, it's just working out how do you harness your own skills in the best ways? And some people are going to be really studious and they're going to dig into accounts and they're going to dig into, I mean, I'm reading about a US private investor who he's worth several hundred million or $1 billion, I think, because his real pastime is digging into patent inquiries and patent applications by some of these companies. And he's been big into aerospace and defense companies and some of the chemical companies because he was trying to work out which ones had some certain products. And he's made phenomenal returns because that's his pastime. He's a chemical engineer by background, I seem to remember. So that's, for me, I'm not a chemical engineer. So some of that patent stuff would be totally above my head. So, and frankly, probably wouldn't interest me that much in terms of, but for him, he worked it out. He worked out his angle and he took it. And that's brilliant.
Appreciate that reply. It's very important for people to find out where they fit in the old mechanics of all this investing and be comfortable in their own skin, doing what they need to do and find an area of expertise. Yeah.
And for some people, it'll be about making a lot of money. It'll be about compounding at 15, 20% per annum and then they can go and talk about it on Twitter and tell everyone it's awesome. But other people will be the other way around. They'll say, I'm really happy if I can make between 6 and 10% per annum with low volatility, because it just means that it's better than putting the money in the bank. I'm outstripping inflation. I'm growing my real return. I don't have to worry about it that much. And my approach is kind of low risk. So I think it's about working out what your goal is, how you want to achieve it, and thinking about the building blocks, the foundations that will get you there.
Indeed. I mean, the important aspect of all of that, I think, with that sort of mindset is that the adage of actually conserving and preserving your capital whilst trying to safeguard it, but growing it incrementally and slowly, and not going for the get rich quick sort of approach to investing.
Definitely. And I see it, you see, like everyone, I sort of have a look on Twitter every once in a while, and sometimes I can't, some people can't help themselves. I think, there's a lot of people sort of peddling the snake oil on Twitter, and you just got to take a step back and say, is this real? And I'll give an example of something. Someone used to live in my village, and I got a text from him about a year and a half ago telling me about an FX trading platform that was doing, I think it was between 5 and 7% returns per month. And I was like, this doesn't ring true. So the first thing I did was I Googled it, and you start to read, all the scam stories about this. And so I just said, look, I sent it back to him. I said, look, here's the link, read this, because I think if you really think about this, you will realize that this is not real. No, it's real, it's real. And we agreed to disagree, but just that level of, you're making returns, sort of high single digit returns in currencies which are notoriously volatile, month in, month out. Just don't believe it. Just got to be sensible with your money.
Absolutely. Trader's graveyard. I wanted to finish on a final question for you, Simon, if I may. You wrote an article back in November of last year, and you titled it, What Experience Tells Us About Investing and Risk. And I think it's a really good point that you've made several great points in that article, but I wanted you to just capture it there as to why it's important for investors to actually make sure that they're not just looking at as you've just touched on there, all the positives regarding a potential investment or a stock, and also look at the risks involved in that, if you may, please.
Yeah, you build up your data bank as an investor over time of the risks involved in a company, whether it's, I think I was talking about leverage at the time. Leverage is fantastic. If you make 10% and you have it levered 2 times, then that translates into 20%. But don't forget, if you have it levered 2 times and it falls 10%, you don't lose 10%, you lose 20%. So leverage is, can be a very intoxicating tool, especially when you see everyone making a lot of money. And so I think a lot of people are using spread betting these days, and that's, using leverage. So, there's risk there, but you've got to sort of I think you learn over time what risks you're prepared to take and others you're just not. And so, as I said earlier about investing in unprofitable businesses for the fund, I just don't do that, because it's not my forte. And when I've analyzed my returns, they're really poor in those kind of concept areas. So that's the first thing for me. Leverage is too much leverage is another thing I stay clear of. And then I think you've, as an investor, you've also got to identify what can cause a company to fail. Whether it's potential regulatory risk in a company that only has one product, that's pretty obvious. If, let's say it was a pharmaceutical company and they were doing some kind of injection for cancer or something like that. If that doesn't work, you've got nowhere to go. Or the government turns around and says, actually, we're not happy with that data, we're going to ban your product. You've got nowhere to go. So there's a single point of failure. And I was listening to a podcast with Pete Davis from Lansdowne the other day, who talked about the single point of failure with Northern Rock, and at the time, because it was basically getting all its financing from the wholesale markets. So if that ever shut, they're in a lot of trouble. So it's trying to identify, does this company have enough diversity of income, whether it's different markets or different products, such that if one of them doesn't work, you're not left high and dry. So again, that's a sort of the third angle, the third leg to the stool, I'd say.
Brilliant. Simon, I think I've completed all my questions there. I wanted to thank you ever so much for coming on the Investing Matters podcast. I know we're going to speak again at some point in the future, But I wanted to thank you as a fund manager at AXA for coming on to this podcast, and I look forward to speaking to you again very, very soon. Thank you very much, sir.
Thanks, Peter. It's been really, really enjoyable. Thanks very much.
Thank you, sir. Take care. God bless, Simon.
Cheers.
Thank you for taking the time to listen to Investing Matters. Be sure to check out the London South East website for free tools and info to research your next investment. You can also join in the conversation on our social media channels. And don't forget to subscribe to our YouTube channel for more content, including our CEO interviews. Catch you next time.